Hello, everyone. In the last class, I had explained about uh, how to account for long-term construction contracts. And I also explained about the overtime method and the point in time method. Okay, so all the conditions required to account for a project over time, and if none of the conditions are satisfied, we account the project at point in time, right? So I'd explained these concepts in the previous videos. So first you have to look at those videos before you come to this video. In this class, what I'm going to do is explain the calculation of the gross profit under overtime and point in time. So I would be doing that explanation with the help of a multiple choice question. So I'm not going to the theory of how it is to be calculated. I would directly do it, apply the concept to a multiple choice question, and you would see how it is calculated. And after that, there are plenty questions in the question bank for you to try out on your own. So let us go to one such question. So have a good look at this. I'm going to explain it directly because I have not explained the theory behind this. So how to calculate the gross profit? I will show it with the help of this multiple choice question. So here, first of all, we should see whether you have to account for the profit over a period of time or point in time. Point in time, as I told you earlier, is when the project is fully complete, revenue is recognized, and no income, revenue, or expense is recognized before that. But loss is recognized immediately, estimated loss. Whereas over time, as and when the construction is progressing, revenue, cost, as well as gross profit is recognized, right? So the conditions for that I have spoken in the previous class. There are three conditions. At least one should be satisfied. And here, one of them is satisfied because these are custom homes built on customers' lots. So customer has control over it using the plans provided by the owners. So then we account for it over time, right? And the question is asking you what amount of gross profit or loss should he report in the 2005 income statement. The construction commenced in 2005, right? So we would use something called the cost to cost method, which is called the input method. That means measuring the progress by the resources put in. So in this case, measuring the progress by the amount of money put in. So that is called cost to cost method, right? There are other methods of estimating the progress, which is output methods also are there, done by an engineering survey to see how much of the project is complete as compared to the full project, right? The percentage of completion of the project is done sometimes by the output method by an engineering survey. And here we are going to, for the CMA exam, it's never going to be the output method. It's going to be the input method, which is the cost to cost method. That is how much cost has been incurred up to date divided by the total cost would give us the percentage of completion. So for home 1, it would be 420 divided by, I'm sorry, it's not 420, the contract price. First of all, we'll find out how much is the total profit. For home 1, it's going to be 420. I'll do everything in thousands minus 360 because cost incurred during 2005 and estimated cost to complete. So that is 360. So the profit, the total profit of the project is 60. But we cannot recognize this whole thing because the project is not complete. So how do we recognize? Cost to cost method. Multiply this into how much cost has been incurred up to date, which is 240, divided by the total cost. Now the total cost would include 240 plus the estimated cost in future to complete. So 240 plus 120, which is 360. So now this gives you the percentage of completion by the input method called cost to cost method, right? So 240 divided by 360 as a percentage, just a minute, 24 divided by 36, as a percentage is around 67%, right? So how much to recognize? So this into 60 would give us 40. So for home 1, we are going to recognize 40. So we have to show for both because he has told you the total amount of gross profit or loss should he report on the 2005 income statement. Now let us go to home 2 and apply the same concept, right? So what is the for home 2? I'll put it as H2. The contract price is 300. The total cost would be the cost incurred and the cost to complete in the future. That is coming to 320. Looks like there's going to be a loss. So there's a 20,000 loss. Now this 20,000 loss, we'll put the percentage. Let's calculate the percentage of loss to be taken by the cost to cost method. That is 280 divided by the total cost 320. Nope, you will not do this. Okay, I just wanted to stress on the fact. That's why I first attempted to apply the percentage. And now I'm telling you, we will not calculate percentage of completion if it's a loss, because on conservative basis, you know, always accountants are conservative, will do their books on a conservative basis. So we would not, if we put a percentage to this, we would be recognizing a lesser loss. So if there's an estimated loss, we recognize the entire thing without applying the percentage. If it's a profit, we apply the percentage of completion and take that amount of profit which the progress has been made, for which the progress has been made, for that will be recognized. But if it's a loss, we don't want to take a lesser loss. We would recognize the entire loss immediately. This is a concept you have to remember. So the total profit which they will recognize is plus 40 and minus 20, right? So that would be 20 gross profit. So B is the answer. I hope you understood the concept here. So what is the takeaway from this question? I have shown you how they recognize profit, how they apply the cost to cost method while recognizing profit, and how to account for a loss. Loss, we would not take a percentage, we would recognize the entire thing. So these are the takeaways. Now, if it runs into the second year, we would calculate the percentage of completion just like this, and we would deduct the previously recognized profit. We would recognize the previously recognized profit to arrive at that particular year's profit. We will do this. There will be more questions on this. We will apply it and then you will understand better. So 20,000 is the answer here. Let's go to another question. Just a minute. Yeah. Right. So now, so in this question, if you see carefully, customers, it's very similar to the question what we have done. The data is similar. Things like something has changed, like from home one to project one and project two. Otherwise, the figures are same. Okay, one more thing I forgot to tell you. The ones billed to customers and received from customers are totally irrelevant to recognize profit. I had explained that in my previous video as well. So you just ignore it, because we are going to recognize revenue based on progress, or based on whether it's over time or point in time, right? We will not recognize revenue by the amount we are going to bill the customers or amount received by the customers, both for over time and point in time. So now, when Pell's customers do not have control over the construction work as it's being done, then it should be accounted at point in time. What does that mean? It means that you have to account for those projects or recognize revenue, expense, and loss only after the project is complete and customer gains control over the projects. Until then, you would not recognize anything. It will all be hidden in the balance sheet in the form of contract assets and contract liabilities, which I'll explain later. So now, here, as we saw previously, it's under profit, 420 minus 360. 420 is the contract price, 360 is the cost. So it's in a profit of 60,000. You will not apply the percentage of completion here, which is 240 by 360. You will not apply this because it is point in time. You will not recognize any profit because the customers do not have control. So you will have to recognize revenue once you hand over the project to the customer. Customer is not getting any benefit before that. Right. So you will not recognize this profit. However, there's going to be loss on project 2, as we saw. 300 is the contract price, 320 is the cost. So there's a loss of 20. Now, as I told you, the point in time is a super conservative method. You don't recognize profits at all, not even a percentage of completion, not even to the extent of percentage of completion. But if there is a loss, an estimated loss, you recognize that immediately. The accounting entries for that I will show you to you later, but you would recognize this loss immediately. So no profit for project 1, loss for project 2. B is the right answer. So I hope you got the concept for point in time and over time very clearly, right? So now we should do more questions for point in time, I mean for over time when there is more than 1 year. So to see that how that accounting is done, how the recognition is done. We'll do that in the coming sessions. Hello friends, welcome to the lesson of revenue recognition and in that long-term contracts. I explained the calculation of profit by or when the project is accounted over a period of time or point in time. I explained it with the help of a multiple choice question in the previous video. So now we will talk about over time profit calculation for the second year. How do we do that, right? And also we would talk about the accounting entries to account for a project under overtime and at a point in time. So that would actually help you so that you wouldn't have to read volumes of the text or any material. If you just look at this video carefully, and because I will be demonstrating it with an example, and that example is a multiple choice question, right? With the help of that multiple choice question, I would show you the accounting entries as well after answering it first. So let us go to the MCQ. I would suggest you look at it carefully. Try to do it, because in the previous video, I have shown you, I've done the explanation. So you should be able to do it. So what we are doing here is, so after pausing, look at my explanation. So they are asking you, what is going to be the gross profit in year 2? Year 1 profit has been given already. They recognize 65,000 in year 1. How they recognize it, please don't go to calculate, because if you do that calculation with cost to cost method, you will not get it. So probably they use an output method, maybe an engineering survey. We are not bothered. We are not going to see how they arrived at this. It's not relevant. Okay, the 65,000 profit was recognized in year 1. So they want year 2. So in year 2, what we do is we'll estimate the profit first. 700,000 is the contract price. Cumulative cost up to the period is 390, and yet to be incurred, estimated cost to complete the project, right? When they look at the year end, they feel that they need 130,000 more to complete the project. You see, when it's completed, cost method. Okay, so now, what's the total cost? Total cost is 390 plus 130. So 390 plus 130 would give us 520. This is the cumulative cost to date and the cost to complete. So this project, cumulative project standing is 180. So there's a 180 profit. 180 profit is there. To this profit, this is the cumulative profit to date, actually. Cumulative, because we have taken the sales price minus the cumulative cost. To this, we'd apply the percentage of completion, right? Using the cost to cost method, which is 390, the cost incurred, divided by the total cost. Total cost is 390 plus 130, which is 520. 520. So what's the percentage of completion? 390 divided by 520 as a percentage, it comes to exactly 75%. This comes to 75%. Fine. So if that comes to 75%, how much we will recognize? So in year 2, it's going to be 180 into 75%, 180 into 75%, which is 135,000. Please don't be in a hurry to tick D. This is the cumulative profit. They want only for year 2. So you have to minus whatever we recognized in year 1. Year 1 profit, you recognize, you minus it. Then you'll get what should be recognized only for year 2. 135 minus 65 is 70,000. So B is the right answer for this and not D. So please keep that in mind. So we got the answer for this. Let us proceed to year 3, just for practice, right? How would you find out for year 3? You should try to do it yourself. Okay, now this was the year 2. So year 3, the situation equal to 170. 170 is a cumulative profit. Deduct from that what we recognize from, okay, this is now 100% complete. So there is nothing, no percentage to calculate. It is like 530 is the cost incurred divided by 530 is the total cost. So it is 100%. So minus from that, if you want only for year 3, minus from that what we recognize in year 1, 65,000. What we recognize in year 2 was 70,000. And what remains? That would be for year 3. So 170 minus 65 minus 70. So 35,000 is what we would recognize. 35,000 is what we would recognize in year 3. There's no such answer there. So 170 minus 65 minus 70. So that would be 35,000. Right? So if you sum up all the 3 years to verify whether we are done correct, sum it all up. We recognize 65 in year 1, 70 in year 2, and 35 in year 3. So how much that sums up to? So 35 plus 70 plus 65 is equal to 170. And that's the profit, total profit for year 3. I mean, cumulative profit for the entire project is 170. So it sums up to that. We recognized it in each of those years. So this is how to do a over time profit calculation when there is more than 1 year involved. I hope you got the answer, you got the concept very clearly on this. We'll do the accounting entries for the same question using the same data in the next session. I want to keep the video short so that you can concentrate on one concept at a time. Hello friends, welcome to the class on revenue recognition and long-term contracts. Let us go to the multiple choice question, and from there we would learn about the accounting entries to account for projects over time and also point in time. So we go to this question, which we have done already. We have already calculated the profit over time in the previous video. And year 1 was already given. So 65,000, we calculated for year 2, which is 70,000, and year 3, which was 35,000. So we have done this for all the years, even though that asked only for year 2. Now, with the help of this question, I will show you the special kind of accounting entries to account for project over time. What will the balance sheet show? We will show how to prepare the income statement, the balance sheet, and the accounting entries for that, and certain accounts as well. So first of all, let us say they're starting the project now, right? And they need capital, right? They need capital. Let us assume we would use the data in the question itself, okay? So let us assume that they bill the customer for the money. Let us not bring in capital and complicate matters, because nowhere is mentioned that capital is brought in. So let us bill the customer, right, in order to get the money. So customers are billed in advance sometimes. So it would be the progress billings. It would be debit accounts receivable 325, right? But we cannot take this to revenue because no performance has been done. So we would put it in a contract liability account called bills on construction in progress. I'm writing all short forms. You can see the textbook for the full form of it in case you forget. But I'm telling you also it's bills on construction in progress. You can name it anything, in fact, okay, whichever you want to. So this is a contract liability account. Then we are not assuming here anything. It's as per the question itself. They made a collection of 300,000. So debit cash, debit cash 300,000, and we credit AR 300,000. Okay, credit AR 300,000 because the customer has paid, right? And then do the construction cumulative cost to date. It's the first year. So it would be debit construction in progress account. Now this is a sort of contract asset account. Construction in progress account, and that is 300. Fortunately for us, the money collected from the customer and the project cost to date is the same. So we don't have to bring in more capital. And credit cash. Whatever cash collected was spent in construction. So the cash balance for year one is 0, right? And then comes, this is the balance sheet accounts, right? Then comes the income statement accounts. For income statement accounts, what would we do? Debit construction expense. Okay, so debiting construction expense with this 300. Debit CIP. Now, this is the difference between an ordinary inventory account or an ordinary work in process account and the construction accounts, because the profit is also debited to the CIP account. Otherwise, the CIP construction in progress account is sort of like a work in process account. Okay, but here the profit is also debited to CIP. What's the profit in year one? The profit, because all this is year one entries that we are passing. Okay, so I should mention that year one somewhere. The profit element is 65,000. So I would debit CIP 65 and credit revenue, construction revenue 365. 365. So now, what we would do is, we would prepare the income statement. Income statement is very simple. From these entries, you can prepare the income statement. Construction revenue, 365. Construction expense, 300. And the profit is automatically coming to 65. Any overheads also would be accounted. Okay, I'm sorry about that. Remember this. Just a minute, please. Yeah. So now for the balance sheet. So for the balance sheet, AR has a balance. AR has a balance. From PCP, it got a debit, right? 325. 325 was a progress billing. And they collected cash. So cash 300. So the balance is 25. Right? Now the CIP account, we will draw the CIP account here. CIP account, it got the first debit for the construction expense. So that is cash 300. And it got another one from the construction revenue, debit 365, which is here. So its balance is 365. We will not drop the cash account because cash came in and cash went out. So cash balance is 0. Then we will draw the BCP account. Now BCP account is only 325, right? So even if you draw it somewhere here, BCP, it's a contract liability account. So that would have a balance of 325 credit from AR. Now, when we draw the balance sheet, I would draw the balance sheet in an account form with liabilities and equity on the left and assets on the right. Right. So what we would do is, we don't have cash. Cash is 0. There is accounts receivable 25. Accounts receivable is 25. Now listen carefully, guys. The contract asset account and the contract liability account, The BCP is the contract liability account. And CIP is the contract asset account, also called as inventory account. Okay, so now this should be netted off and shown. We don't have to pass the accounting entries until the end of the project. So 365 is greater than 325. 365 is greater than 325. So we would show the net balance on the balance sheet. So the net 365 minus 325 is 40. So CIP, we would put it as 40. If the liabilities was greater, suppose the liabilities was 365 and asset was 325, we would have put BCP on the liability side as 40. They are generally current assets and current liability, but it depends on the circumstance. Okay, and that's it. And then this is 65. Equity, the profit here gets close to retained earnings. So the retained earnings would be 65. So this is how the balance sheet is done. The balance sheet also agrees. And this is how the income statement is done. So this is the way accounting is done for an overtime project. You can continue the entries for year 2. But please keep in mind, these are balance sheet accounts. So they are permanent accounts. So they would continue into the balance sheet of the second year. That is 365, 325, and this 25. Probably you would have cash as well. So you can start off with billing the customer 320 and 220, just the way I have done this. Collect cash 200. Then the construction expense for year 2, since it's cumulative, is going to be only 90,000. So you would do all that exactly like I have done and see if your balance sheet tallies as well, the way I have done. So this is how it's done over time. If it was point in time, you wouldn't recognize these revenues or expenses. It would have remained in the CIP account and the BCP account. You would have carried it onto the balance sheet until the end of the project. And in the end of the project, you would close the BCP account to revenue, that is debiting BCP, the contract liability, crediting revenue, and crediting the asset account, CIP account, and debiting construction expense, and you would have the profit at the end. That's how you would do it for point in time. For overtime, this is how it is done. I would give you the homework to do it for year 2 and year 3 and see whether you're familiar with all the terms and how it is accounted. So you would do that for homework. And if you have a problem in doing it, you can always ask me during office hours and I would explain it to you for year 2 and year 3 as well. So that's about the accounting. You would get multiple choice questions on this. So we would do that in the next session. Hello, friends. In this video of revenue recognition, we would do a question on project or long-term contracts when there is a loss and the calculation for that. We would do that with this MCQ, which I'm going to show you now. Read the question and try to solve it yourself. So the project is going to be accounted over time. He has told you that. Sometimes they would give a condition, which would be one of those 3 conditions to account a project over time, which we have discussed in the previous class. So that time you have to, it's understood that you will go for overtime calculations, right? So you'd recognize profit as and when there is progress. So now they want the profit for the year 2002, and they have given you the profit for 2001. So how do we do it? First of all, take the contract price for year 2. See the profit estimate for year 2. I would use full figures because it looks like there will be some odd figures there. So I cannot do it in thousands. So 1.7 million. And what is the estimated cost? Incurred was this much. Cumulative. It has to be cumulative. It cannot add up, even though they are not, they're told their total costs incurred. Okay, so to date. Okay, so it is 1.3 million plus they require another 200,000 to complete it. So now it's exceeding the project contract price. It's becoming 1,550,000. So we have loss of 1,550,000. So we have loss of 50,000 for year 2. Okay, so for year 2, there is no percentage. You cannot apply a percentage of completion for a loss, as I discussed earlier. You have to recognize the entire loss for year 2, which is 50,000. There's an answer of 50,000 there, but don't be in a hurry. This is the cumulative loss up to date, right? So what we should do is, we have to find out the loss only for year 2. So we, as of now, the cumulative loss as of year 2, it's going to be 50,000. The project is under loss as of year 2. That's what it means. But the amount to be recognized in year 2 would be 50,000 minus the profit, what was recognized before, because there's no longer a profit. There is no longer a profit. So minus 50,000 minus 92,308, which would give us a loss of 142,308. And that is the right answer. Now, if you guys are confused what's happening, just look at it like this. The sum of all the year's profit should sum up to the project loss. So year 1, they recognized 92,308 profit. And in year 2, we should recognize 142,308 loss. What is the total? The total will give us the profit or loss, the total profit or loss of the project as of that date. So 92,308 minus 142,308 would give us minus 50,000. So that is the situation as of year end, year 2, right? So that is how we do project calculation which has a loss. Try to do more questions on this, on the calculation of profit over time and point in time, because I will not be able to do all the questions in the class. So you will do it yourself. Whenever you have a problem, you can contact me anytime. So this is going to be it. We'll do more questions in the coming sessions. Hello, friends. Welcome to another session on long-term contracts. And in this class, I'll be doing a multiple choice questions which involves contract assets for a long-term contract, the CIP account, which I had explained in the previous video. So let us go on with the question. It will be more clear. So as you know, we have already done this question in the previous video. And the answer for that was 20,000 loss. And the question was saying that the customers do not have any control over the construction work. So we accounted the profit based on the point in time method. We will not account profit in that method, but if there's a loss, we would account for it. And that is why B was the answer. Right? B was the answer. In fact, we can even do it without working out, because profit is never recognized in a point in time projects, right? Only loss is recognized. So the only answer with the loss is this. So we could have done it without even working out. Okay, but that you will do it when you're in a hurry. Otherwise, you can work it out and arrive at 20,000. Now, a question related to this data is the next question. He says now that Pell's customers owns the land and contract with Pell to build to their specifications on their land. And the customers control the work as it's being performed. So in other words, he's implying that it should be accounted over time. These are the conditions for overtime, which I have discussed in the previous videos. So now they want what will be the balance in the contract asset account. I've explained the contract asset account and the contract liability accounts in the previous videos. You can have a look at it. So unless you go through that explanation, you will not be able to do this. So Pell's construction in progress account, the contract, the asset account for both the projects at the end of 2005. So that's what we need to do. We have to adopt the cost to cost method, and it should be over time because the customers have control over the construction. So now, how we will do that? So we have already done for project one. We'll talk about project one. So project one, it's going to be, the profit is going to be 420 minus these two amounts, the cost incurred during 2005, and it's begun in 2005, plus the estimated cost to complete the project. So the total cost would be 360. The profit is going to be 60, but it's over time. We'll apply the percentage method, right? So percentage of completion, that is cost to cost method. 240 is the cost incurred to date, divided by 360, which is the total cost, and we'll get 40 as the profit. Now, for the construction in progress account, the cost incurred to date will be debited. The entry, I'll just put the entry also. You don't have to do that in the exam, but for better understanding. So debit CIP 240, the cost incurred to date. Credit cash for cost incurred to the year, in that year, that is 2005 it started. So that will be 240, right? And also, when we account for the expense, it would be debit construction expense, which is 240. This is the first year. And debit the profit element to CIP. So that would be 40. And with credit revenue to 80. So now the CIP has got two debits now. For project one, I'll put the CIP for project one. Again, I'm telling you, we don't have to do all this for the exam. It is for your understanding. Okay. So cash 240, revenue 40. So this is project one 280, right? Now project two, as I showed you, is in a loss. 300 is the contract price. 320 is the estimated cost, incurred and estimated cost will be 320. So, sorry, 320. So you have a loss of 20, and that should be recognized in full. That should be recognized in full. So how would you recognize that? First of all, for project two, the cost incurred would be debited to CIP account. Debit CIP 280. It's a contract asset account, so you're accumulating the cost there. It's like a work in process account. And credit cash 280. And then, since it's a loss, since it's a loss, what would happen is debit construction expense. Construction expense part should be to 280. So first year, so we can take the full amount. Credit CIP because it's a loss. Credit CIP fully 20. Credit. And the balancing figure would be the construction revenue. Will be 260. So in other words, the income statement would look something like this. Revenue 260, expense 280, and you have a loss of 20, which you are recognizing in full. So what about the CIP account for part for project 2? CIP project 2. Cash 280. CIP credit. So by construction expense, you're getting a credit of 20. So the balance of this would be 260. 280 debit and credit of 20. So 260. Both together, the CIP account would be 280 plus 260. So 280 plus 260, which is equal to 540. So 540 should be the CIP accounts for both the projects. So you cannot do this unless you have seen my video where I have explained the CIP and BCP accounts and the related accounting entries, right? You can look at only that video. It would save you a lot of reading from the text or any other material, and it can be understood easily. And I'm always there if you have not understood it to clarify. So let's see whether there is a 540 answer. It is there indeed. So it is C, the right answer. We'll do more multiple choice questions just for you to get a hold of the CIP and BCP accounts. The profit calculation, I presume that you would have got the hang of it now. If not, you have to do more questions. So we will do some more questions in the next session on the contract asset and the contract liability accounts. Hello, everyone. We are welcome to another session on revenue recognition, and we are going to do more questions on long-term contracts. So let's go on with it. This question is testing you on the conditions which is required to account a contract as a overtime contract. There are two ways of accounting long-term contracts, as I have discussed in the previous video sessions. One is overtime and one is point in time. So he's asking you here, what would be the condition, circumstance where he should, one should account it as overtime contract. There are three conditions to it, which I have discussed in the previous class. Just as a reminder, I will put those conditions again for you to have a look. Yeah, here are those conditions. One is an annual maintenance contract where the customer is already owning the asset and cleaning and regular annual maintenance is done on that asset. So customer is getting the benefits. He consumes the benefits as the company performs them. And the customer is getting the benefit on a straight line basis. The company would issue invoice periodically and recognize revenue as the invoices are issued. So generally, they shouldn't be recognized revenue as the invoices are issued for long-term contracts, it should go as per performance. But here, since performance is done on a straight line basis, revenue can be recognized as invoices are issued periodically. Costs are recognized when incurred. That is one of the conditions. The other condition is company's performance creates or enhances an asset, such as a work in progress, that the customer controls. The customer is controlling the work as the work is being done. Here he has given you an example of a contract to build a structure which the customer owns. I had given you, if you remember, a land with where the customer is owning a building and a fence is being constructed around it. So as and when the fence is constructed and the percentage of completion is being performed, I mean the performance is being done, the contractor can recognize income. So that's the second condition. The third one is the company's performance does not create an asset which can be used alternatively by the company, right? The company's performance does not create an asset with an alternate use. It is only for the customer. It's custom made to his specifications. And the company maintains the right for payment for the complete performance completed to date. Okay, so in such situations, also the company can recognize revenue and income over period of time, right? So that is how that is what I had discussed in the previous class, but this was just a revision to remind you of those. And so with the help of that, we can answer this question. So a company's performance creates an asset with an alternate use? No, it should not have an alternate use. So this is not the condition. Production processes can be readily divided into definite stages. Those were not one of those three conditions. Cash being received will create a liability rather than for it to be accounted over time. Okay, so this is not one of the conditions. D is one of the conditions. The company's performance creates, just the second one, if you remember, creates or enhances an asset that the customer controls as work is being done. So when these conditions, one of those conditions are satisfied, the company can account it for over time. If none of those conditions are satisfied, the company will account it as point in time when all the performances are completed. Only then the company can recognize revenue, expense, and profit. Let's go to the next question. So pause it, read it well, try to do it, struggle and try and do it. And if you can't, you can look into my explanation, which I'm going to explain right away. So they asked you the gross profit to be recognized in May 2006 here. So for that, you need to know how much was recognized in 2005. That has to be done because only then we can recognize, we can go and see how much was done in 2006. So in 2005, let's go to 2005. It is, it is going to be 10 million. Okay, I'll put it in thousands. So 10 million will be 1,000, right? And then, yes, 8 million, as it was estimated before, 8 million would be the cost, both incurred and estimated to complete. Something has gone wrong here. 10 million is 10,000. Okay, right. And that would be 8,000. If you're putting it in thousands, right? And then this is 2 million would be the profit. And we would account for it on a percentage of completion basis, cost to cost method. So that would be 2 million the cost incurred, divided by the total cost, 2 plus 6, 8 million. So it is 25% complete. 2 divided by 8 is 25%. 2 divided by 8 into 2000. So 500,000 is recognized in 2005. So in 2006, it would be 10 million. We have to estimate the profit again. 10 million is 10,000. Since I'm putting in thousands, I'm truncating that extra 3 zeros. And the total cost would be cost incurred and cost expected to complete, because it's not completed in May 2006. It will complete in August 2006. So there's a lot more work to do. So 6,250 plus 2,250, it's 9 million. The cost incurred and cost estimated to complete. 1 million is the profit. So something has gone wrong, in the sense things have gone up compared to their previous estimate. And so their resultant profit is going to be less. Multiply this into the percentage completed. That is 6,750 divided by the sum of these two. 6,750 plus 2,250. That is 9,000. So this is a cumulative condition, right? So it is cumulative, up to date, cost incurred up to date. It's not only for that year. Okay. So up to now, they have completed 75%. If you calculate the percentage, it's going to be 6,750 divided by 9,000 as a percentage is 75%. Previously, it was 25%, right? So cumulative now is 75%. So 1,000 into 75% would be 750 cumulative profit to be recognized. But they have already recognized 500 in 2005. You minus that 500 because you want to find out how much they should recognize only for the year ended 2006. So that would be 250. So A is the right answer. There are many questions like this, but sometimes be careful. They would ask you the revenue to be recognized. So you would apply the percentage of completion to the revenue. So you should see carefully whether they're asking the gross profit to be recognized or revenue to be recognized. Well, so this kind of questions I have done before, but why I have selected this question is because the next question based on the same data is asking you about the contract assets to be recognized. So here, the current assets reported on the company's May 2006 statement of financial position or the balance sheet would be, as a result of this contract, would be what? See, one is an unconditional asset. A receivable they have to pay. Okay. Another one is a conditional, right? So they have actually completed a part, but they would be taking it as a percentage basis on how much they have completed. Okay, so the revenue would be recognized that way. So here, if you remember, we have dealt with how to do the accounting entries, how to recognize a contract asset and a contract liability. All that was done in the previous videos. So this is just a test for you. So actually, you can do this even without touching a calculator. One of the students actually did it in a live class without touching his calculator, absolutely. So what would be the accounts receivable? And what would be the contract asset? Right? Contract asset is nothing but the CIP, which I have spoken about in the previous classes. So now, if you look at this data, accounts receivable, see the progress billing done up to date is 6,000. Out of that, the customer has paid 5,500. So if you notice, if you remember, the accounts receivable, the progress billings would be debit accounts receivable 6,000 and credit bills on construction in progress, which is a contract liability, right? And then if they receive cash, it would be debit cash, 5,500. This is cumulative, of course, and credit AR 5,500. So the AR should be having 6,000 was built and they received cash. So AR should be having a 500,000, right? So 500,000 should be the AR. So let's go and see the answers. There are two answers with 500,000. So we can blindly eliminate. We can blindly eliminate these two answers. So it should be one of these answers. Now let us see the contract asset, which is the CIP. Now CIP would be 6,750 plus a profit element, because on overtime contracts, we would account for the profit as well, right? So plus the profit element, less the progress billing, which is the contract liability. That's how it would be. So it can never be, it can never be 6,750. You will have to minus the progress billing. Okay, so here in the choices, if you notice, if you notice in the choices, one of the choices which we didn't eliminate, right? We had, if you remember, eliminated these two. So one of the choices is 6,750. It can never be, contract asset cannot be 6,750, is because we'll be adding a profit to it, which will enhance it further, but only the net amount is shown after you net it off with the current liability, with the contract liability, which is nothing but the progress billing. So it has to be something less than 6,750. So the only answer less than 6,750 is this, among the ones not eliminated. Okay, so it has to be D, the answer. But let us arrive at 1,500, right? We'll arrive at 1,500. This is a way to do it without touching the calculator. You can get your accounts receivable and contract assets by just knowing the concept that it cannot be 6,750. So let us get it properly. So yes, the contract assets would be the actual, the CIP would have the actual cost incurred up to date. You saw my accounting entries in the previous video, plus a profit element. So what is the profit for cumulative profit for 2006? As we have calculated earlier, right? We calculated that 10,000 is the contract price, 9,000 was the cost, 1,000 was the profit, but we need to be accounting 75% of it. So it would have the cumulative profit up to date, not only for year 2, year 1 and year 2 together. So the contract asset balance is going to be 7,500. This would be the CIP. When you're presenting in the balance sheet, you would see which is more, CIP or BCP. Progress billings would go to an account called billings on construction in progress, okay, which is a liability, contract liability, as the contract has not been performed fully. So this would be 6,000. Since the contract asset, this is the BCP, contract liability. Since the contract asset is greater than contract liability, we would show the contract asset as 1,500. So that would be the current asset, 1,500. So the answer would be D, which we already did without the calculator even, okay, without even calculating. So the contract asset, sometimes called the inventory account, is 1,500 and accounts receivable 500,000. So this question was just to give you familiarity of not only calculating the gross profit or revenue on an overtime basis, but also to get the balance sheet figures as well, which is the contract assets and contract liabilities. So with that, we can say we have concluded accounting for discussions on accounting for long-term contracts. We'll go on to the next topic of revenue recognition in the next video. Hello, everyone. This is the last part of revenue recognition, which is income measurement. So let us discuss that. I'll take you to the text. So what is basically income? Income is net profit. Net profit is nothing but revenues and gains. I will tell you the difference shortly between revenues and gains. From these revenues and gains, you minus expenses and losses, and then further reduce it by income tax, and you would have your net profit. The multiple step income statement was explained in the earliest videos. You can have a look at that. So when do you and how do you recognize expense? It's on the accrual basis. It's not on cash basis. It's recognized as and when incurred. All this you know already. But you should remember that it's basically by the matching principle we recognize expenses. That means if a particular revenue is recognized on the income statement, the expenses related to that revenue should be put or recognized on the income statement. Okay, so that is that's how it works. It's not necessary you have to spend that amount in cash. So expenses are recognized based on one of the following. One is the cause effect. Cause effect is what caused the revenue, right? So that expense should be recognized. For example, cost of goods sold caused a revenue to happen. So that would be recognized. The other one is systematic and rational allocation of expense, such as allocating the cost of fixed assets to the periods over which the benefit is received, very commonly known as depreciation. So that way we would recognize, and sometimes immediate recognition when we know that there is no future benefit would happen. It happened to us once. We follow the accrual system, of course, and we follow the allowance method for bad debts or for credit losses. But it so happened one time that there was an unexpected bad debt. We were providing whenever there was debts which were doubtful. So we were recognizing credit losses for it, and it was going on well. But there was one particular accounts receivable with a $1 million receivable, right? There was no sign that they are not going to pay. We had no idea at all. We did not even provide any credit loss expense because they were a well-known customer who were paying very promptly. Then one fine day, out of the blue, it was announced that they went bankrupt. So now, of course, we cannot now put a 10% credit loss or anything like that. We have to recognize the entire amount as an expense. So that would be immediate recognition. Of course, we routed it through the allowance account. So we debited credit loss expense, credited allowance for credit losses, and then we wrote off the AR completely against that allowance. So that is how we did it. So that is an example of immediate recognition. Now, what are gains and losses? See, gains are amounts which increases the net income, also called equity, from transactions not the core transactions of the company. For example, a company might be selling garments, so that is their main business. And if they sell a fixed asset and get a gain out of it, that is, they sell it for a higher value than the book value, then that would be a gain it would be not part of central operations, and it would be not a part of operating income as well. It would be shown below the operating income as gains. And losses also are a part, do not result from an expense. Expense is from the main core business. Losses are transactions resulting from transactions which are not from the company's main business. Like, for example, as I told you, you sold a fixed asset at a loss that is less than the book value. Then it would be called a loss because selling fixed assets is not a part of your central business. So that again would be shown below the operating income. So that's about gains and losses. It's not from the core business of the company. That's all. And then there is another concept on gains and losses on the disposal of fixed assets. So whenever they have decided to sell an asset, it should be classified separately from the long-lived assets or the assets still in use, right? So it should be reclassified from held for use to held for sale. When should it be classified this way? When all of the following criteria are met, not one, all. Management has committed to a plan to sell, asset or disposal group. Disposal group is a group of assets which they are planning to sell. To be sold is available for immediate sale. There's no doubt about it. Anybody can come and buy it anytime. An active program or advertising to locate buyers have taken place, right? And the sales is probable within a year, unless something goes beyond the control. Generally, they should be selling it within a year, right? And the asset or disposal group is actively marketed at a reasonable price, right? And then actions required to complete the plan to sell may not be revoked. They are going to sell it. They may not change their mind. That's what it means. So I don't think you have to memorize this because it's common sense anyway, but they can ask you in a multiple choice question. So you better know these conditions, right? And get yourself familiar with the conditions rather than actually memorizing them. And later on, how would you account it? When all these conditions are satisfied, you remove them from the long-lived assets or assets held for use and debit held for sale at its lower of carrying amount or its fair value less cost to sell. Now, suppose the carrying amount, you know what's the carrying amount? Carrying amount is the original cost less depreciation. For example, if the original cost, I'll put it as OC, don't get confused, is 1,000 and accumulated depreciation is, let us say, 800, the carrying amount is 200. And then we'll compare it with its fair value. Let us say its fair value is 250, but the cost to sell, maybe a broker is involved. Okay, the cost to sell maybe, let us say 100. It's too high, but I'm just giving you a wild example. Okay, so it's 100. And this would come to, let us say, 150, 250 minus 100. So the lower of the cost or fair value, less cost to sell. The fair value is higher, but including cost to sell, it would become lower. So we have to recognize it at this cost and recognize a write down. So there will be a write down as well, which is an impairment loss, right? So you would recognize that. So in other words, let me just put you an entry. So basically, what would you do? You would debit held for sale asset at 150. Yeah, it is actually the lower, okay? lower. And then you would actually debit the loss due to impairment, right? Which is actually 50, right? 200 minus 150. So that is the loss of impairment. Okay, so that would be 50. And then you would credit the original cost for held for use asset by 1,000. Okay, and also you should debit, you're removing the accumulated depreciation. So debit accumulated depreciation for 800. So the debits and credits do tally, if you notice, right? You're removing the original cost from the held for use asset. I'll put it here, held for use. Held for use asset. Okay. Anyway, there's an example, a detailed example there. Down Hawk has provided that. So this is just to give you an idea how it goes. Okay. It would be very clear with the example. So that is how it is. And remember one thing, one important thing, held for sale asset is not to be depreciated, right? And then it will always be monitored with its fair value. So if its fair value after some time goes down, it's recognized immediately, right? And if the fair value goes up, eventually before it is sold, if it goes up, you would actually recognize a gain, but only to the extent to the losses which you had written down previously. In other words, it should never exceed the book value when it was originally classified as held for use, held for sale asset. So in other words, there's no way you can bump it up more than its book value, right? And then if there's any liabilities related to the held for sale assets, that should be shown as a separate line in the liability side without netting off, right? So that's about it. And then when it sells, you would recognize the remaining gain or loss, which you have not already recognized. Let us see with this lovely example. Hawk has explained this very nicely. So here there's an 8,000 watt generator going to be replaced with a 12,000 watt generator. So the held for and the carrying value for the generator which is used, or the long-lived asset, is 40,000. That is the held for use less the accumulated, the original cost less the accumulated depreciation. So 65 minus 25 is 40. They determined that the fair value less the cost to sell is 30,000. So this is what they should classify it as held for sale. It is lower than 40,000. So they should recognize a loss. If it is higher, they would recognize only 40,000. Suppose the fair value less cost for sale, I'm just telling you, if the fair value less the cost to sell was, instead of 30,000, let us say it was 50,000. Then what do? You would recognize it 40,000 only. You would not recognize 50,000, right? So the lower of the carrying amount and the fair value less cost to sell is what you're going to recognize. The entry, as I showed you before, would be debiting the held for sale equipment, debiting accumulated depreciation. You're removing it out basically. And there's a decline in fair value from 40 to 30,000 that is recognized, and you credit held for use equipment. And this loss is a loss from continuing operations. The loss is a loss from continuing operations. Don't confuse it with operating income. The gains and losses are a part of continuing operations. It's not a part of operating income. So now, 3 months later, when they sell it for 27,000 cash, okay, actually they sold it for 28,000, but brokerage was 1,000, so they would recognize cash of 27,000. The held for sale equipment is 30,000, which is credited, and then there's a loss of 3,000. This is a loss which was not previously recognized, so that is recognized now when they sell it. So that's about it. And when a fixed asset is sold, when held for use, well, if a fixed asset is sold while it's still classified as held and used, okay, an asset that has not been reclassified as held for sale, then like suddenly you decide to sell it, then the entry would be removing everything related to the fixed assets. For example, I have given you this example in the previous classes. Let us say the fixed asset, which is the original cost of it is, let us say 100. A very simple example. Accumulated depreciation, let us say 800. Carrying value is 200 and sold for, let us say 300. So whatever you received cash, you would debit. Accumulated depreciation, you want to remove this, you would debit it because it's the original credit balance. Account for the fixed cost, remove that completely. Balance it out. Balance it out. So something went wrong here. Make this 1,000, please. Okay, 1,000 minus 800 is 200, and then you sold it for 300. Okay, that makes sense now. Right. Remove the historical cost completely. You're removing it because you have sold it. It should get off your books. Now, you plug in the difference. The debit side is more than the credit side. So you would credit a gain of 100 to make it the same. So it's a plug-in. The gain or a loss is a plug-in. So it is a gain clearly here. We sold it for 100 more. So that would be accounted. You can do the similar entry for a loss. I would tell you to do the entry if you are not sold it for 300, but you had sold it for as less as 50. So you would be recognizing a loss. Do the same entries. Remove the fixed asset completely from the books at original cost. Remove the related depreciation, right? And then the account for the cash first. Then the plug-in figure is the gain or the loss to make the debits and credits equal. That's it. So that's how you'd account for an asset which was held for use and suddenly you have decided to sell it. So how do you present the gains and loss on the income statement? It is not a part of operating income, as simple as that. Okay. And suppose it's a part of the plan to sell a component of the business, a segment of the business, then it should be shown as a part of discontinued operations. In the discontinued operations, the income or loss of the operation should be shown along with the sale of the segment's assets, along with the gains or losses from the sale of the segment assets. It can be grouped as one line item. You don't have to show income from discontinued operations separately and losses or gains from selling the segment assets separately. You can club it into one, just like they have shown you here. But it should not be shown as a part of income from continuing operations in such a case. So income from continuing operations would include the gains and loss of assets which are sold from the core business, which is not to be discontinued. Then the gains and losses from operations of the discontinued component should be shown separately, including gain or loss on the disposal of the assets. You can include it and then show the net income tax benefit or loss or expense as a separate line item and then arrive at the net income. The income from continuing operations, income tax provision should be shown separately. Okay, and only then you come at the net income from continuing operations. Then discontinued operations should be shown separately with the tax effects separately, right? So you can show it, even net of tax effects, it can be shown. So that is about it. So main thing is this, it should be removed. It should be removed from the income from continuing operation. So just let us read one line from here. I would request you to read read this paragraph. All gains and losses incurred in the discontinued operations are reported net of tax in the period in which the loss has occurred. Okay, so the gain or loss from operations and the gain or loss from disposal, when disposal takes place, are combined, reported on one line, followed by the income tax effect on the next line, either tax benefit or tax expense. Right? So they should be shown in that way. And then you show the net income. So that the income tax benefit and expenses from the discontinued component is separated from the continuing operations income tax expenses. So this is about it. This is the presentation on the balance sheet for the gains and losses. And yes, the next lesson would be about involuntary disposals. That would be in the next session. Hello, friends. Welcome to another session on revenue recognition and under that income measurement. So now here in today's class, we are going to study, in this class rather, we are going to study about involuntary conversions. Let's go to the text and see what it's all about. So involuntary disposals and conversions would be when a property is stolen, destroyed, or seized by the government, which is called expropriation of assets seized by the government for public purposes. And the condemnation settlement or the insurance settlement what they receive from the government or the insurance settlement would be the proceeds received on the asset. Right? And it would be accounted the same way as a disposal, as a voluntary disposal. Only thing, the debit cash would be the insurance amount or the condemnation settlement or the settlement, right? If this happens to be more than the book value, you have a gain. Otherwise, you have a loss. As simple as that. That's all. Nothing else should be known for this. But there's an important note here, which needs to be looked into. Supposing there's a cleanup or any cost associated with determining the fair value of the property or the condemnation agreement itself, any additional cost related to this asset should be added to the book value, not expensed separately. Looks like it has to be added to the book value of the old assets, and then you have to determine the gain or loss on the involuntary disposal. Any cost associated with the search and purchase of a replacement asset should be capitalized as the cost of new asset and depreciated over the estimated life, useful life. So though these are the things which you should be noted, for involuntary disposals. That's it. Now the next topic here is comprehensive income, which was explained in very great detail, and we have done multiple choice questions also on this in the earliest videos of section A. So you can refer to those. I will not repeat it again in this part of it. And with that, we have finished section A and we'll be going to section B, but I have not yet done integrated reporting, which I will do in the next session before we go on to section B. So revenue recognition is over, but before we actually move on to any other topic, we'll do some multiple choice questions on income measurement and see how you perform. That would be done in the next video. Hello, everyone. In the last class, we discussed the concept of income measurement which included depreciation also. Now here's a multiple choice question, which we would do right now. It's related to depreciation. Yes, so this is a question. The company uses straight line depreciation for property, plant, and equipment. So what they require is what amount was debited to accumulated depreciation during 2005 because of property, plant, and equipment disposals. So when you dispose an equipment, we remove the depreciation, related depreciation, which I discussed in the previous video for disposals. I discussed the accounting entry and all the concepts related to that. So he's asking you that part, the disposals part. So what we can do is we can draw the T account. I will do it that method, the T account. So accumulated depreciation. We have a credit balance. So it started off with 2004 balance 370. I'm doing it in thousands. And the balance carried down is 400. So the account should have a 400 balance in the end. They have told you that the depreciation expense for 2005 and 2004 is 50,000. So now 2004 depreciation is already included in this 370. 2005 happened during the year. So the depreciation expense would be a debit to depreciation expense and credit to the accumulated depreciation. So 55, right? And the balance, the credit side is 425. Debit side also should be 425, but it's only 400. So obviously, there has been a disposal, depreciation debit, fixed asset and other accounts would be credited. So that is 25,000 to make debit and credit equal. So B is the right answer. I can do it the other way also, right? So if you want to do it the other way, without the T account, they started with the 370 balance of 2004. The depreciation during the year was 55. So the account should have a balance of 425, but it has a balance of 400. The closing balance was 400. So 25 was removed due to disposals. So we can do it this way as well. So with that, we finished the lesson of revenue recognition, wherein we studied so many things, including long-term contracts. And we did a lot of multiple choice questions also. So what I would suggest you to do more multiple choice questions on revenue recognition. And let me know if you have any questions. We can solve it together once you contact me.